Thanks for joining us. I'm Tom Schmidt from Ticker Tape Investments. Happy to have all you guys here. It's great to see some of you folks are repeat attendees and some have not been to these events prior to today. We do them every Thursday night, so if you haven't seen the prior ones, go back and check them out on our website or our LinkedIn account or our YouTube channel. There's lots of helpful content for all sorts of topics for investors. Tonight, obviously, we're going to talk about pre-IPO investing, the key to market-beating returns. And if you haven't heard, Ticker Tape does a lot of these types of deals. The idea is to invest in a company when it's privately held and then sell it when it goes public to capture that spread in value. And we've done this a bunch of times, everything from SoFi and Palantir to SpaceX and USA Rare Earth, Outbrain, Kraken, etc. So we love this investing space. Of course, we also do everything else too. Precious metals, apartments, hotels, emergency rooms, litigation funding, all sorts of different deals. But this is kind of our favorite. We see this as one of the best risk return opportunities that's out there. So what we're going to talk about today is why are pre-IPO deals attractive? Why do we like them? What are some of the challenges of access and evaluation of deals? We'll talk about a couple of case studies, give you a sense of what to expect when you get into this space, and last, some strategies on how to find them, how to get in, etc. So let's talk first about why we like this space, why we like this asset class. So number one, we think that these opportunities offer higher returns at a lower risk. They also tend to involve less volatility because volatility happens after the company goes public. And of course, our strategy is to sell when that happens, right? So we get out before the real volatility happens. Now, having said that, typically we're a week or two from the minute we have full liquidity. Sometimes it takes 10 days or so before we are totally out of our position. And so we do suffer some volatility there, but it's kind of a different idea than the overall year after year volatility. The other idea is that, and you've heard me say this before, a lot of times by the time a company goes public, the money's already been made. Investors have been in it typically for a long time. It's gone from a zero valuation to a multi-billion-dollar valuation. And so if you invest after they go public, you're missing out on all of that value creation. And so the idea is to get in when it's private, after it's de-risked. We don't get in early stage. This is not talking about investing in startups that hopefully someday will go public. This is companies that are already established, recurring revenue, growth, profitability, high valuation, typically around $1 billion or more at the time we invest, so that we're eliminating a lot of that risk from that equation. And then obviously, this is something that typically institutions, family offices, ultra wealthy investors have had access to. But given the new markets that are out there, if you partner with somebody like a Ticker Tape, so you kind of get it to play at a higher level, you can actually get access to a lot of these deals. What we're looking for is a 2 to 4 year time horizon. We'll talk about a couple examples that were much shorter than that, but those are sort of, on the luckier end of the spectrum, right? But if we can get out in 2 to 3 years, we're real happy with that. And some deals, of course, if you invest in enough of these, are going to last longer. And then there's kind of that other class I talk about, like a SpaceX, or we're doing a round of Anthropic right now. Those are sort of calculated longer term holds. I've told investors, hey, if you want to get in SpaceX with us, I hope you're thinking in terms of you're making this investment not for your children, but for your grandchildren, because it's likely to be quite a while before the SpaceX deal liquidates. But the typical sort of middle of the fairway is a 2 to 4 year hold, looking for a 40% average markup from the sort of final private round to the day they go public. And you can capture a little bit more than 40%. Typically, if there's a hold period, there's a waiting period from the day the company goes public to the day the shares free up, there can be significant appreciation there, and that's how we get some much higher returns. But looking at 1,000 different deals, you're going to see about a 40% markup. But if you did that over and over again with a short period of time, you're going to end up with a much better portfolio at the end of the day. And then you're looking for that 70 to 90% success rate of late stage companies reaching a liquidity event. There are situations you kind of got to be aware of. I know of companies out there that I look at them and I go, you know, there's no reason for that group to go public. And so you want to watch out for those. SpaceX theoretically could be one of those. But if to the extent you're looking at something like that, you want to make sure you go in eyes wide open and you know what we're talking about. Now, this is something you're going to hear us talk more and more about at Ticker Tape, is this idea of rolling wins. And if you study the math of investing returns, you start looking at things like this and see how this can really dramatically affect your overall return. This notion that you're going to take assets and buy assets and then just hold them for the long term, that's nice. And yes, compounding is great. But what really can step change your return profile is having a short-term win, take the principal and the profit and put it in another deal and roll that over several times. And when you do that, you get access to a potentially a significant improvement in the amount that you make over time. So for instance, you start with 100,000, you put it in a late stage private company, 18 to 36 months, you exit. When that company goes public, let's say you double your money, now you got 200,000, you go and you roll that 200,000 into the next deal. Now when it doubles, you got 400,000. And if it doubles in a third deal, you got 800,000, as opposed to buying and holding over time. Your chance of taking 100 to 800 is very low. Even if you buy a stock, sell it, buy a stock, sell it, buy a stock, sell it, chances are with publicly traded investments, you're not going to do that. Chances are with apartment deals, you can do that, but instead of a 3 to 6 year time horizon, you're talking more about a 20 to 25 year time horizon, because each deal is 5 to 7 years before you double your money. So that's really what we're looking at. An example here, similar example, the person who invests 100,000 and then just holds the asset may exit in 9 years at 3 times their money. Whereas the person who makes 3 separate pre-IPO deals, each of which doubles, in other words, the first investment triples. But if each one doubles, all of a sudden you got a lot more money at the end of that period. And so even with modest returns and short durations, the rolling win strategy is going to generate significantly more capital for investors. And, you know, obviously you want to be doing more than one at a time. So in other words, we're not talking about take your whole portfolio, put it in one, double it. You want to have these staggered out over time so that you got a constantly rolling over portfolio. So again, kind of comparing the two ideas, you know, the buy and hold strategy is for folks that aren't sophisticated enough to evaluate repeated investments, right? So that's one thing. The other thing is if your nest egg or whatever is large enough that you don't need to make a significant jump in the size of your nest egg. In other words, you have enough investable cash to put it in cash flowing deals and such that will generate the income you need for the rest of your life. Okay, great. Then don't go through this trouble. Don't take this risk. But if you're looking to grow the size of your nest egg so that then when you put it in an 8%, 9%, 10% cash flowing deal, it's generating the income you need to satisfy you and your family. That's why you want to look at these deals. So instead of buying and holding in the S&P 500, which is fine, this is a strategy that's going to result in a significant increase in the value of your overall portfolio. So again, I have to be careful when I talk about these things, because a lot of investors that I've been talking to talk about, oh, I looked at this deal or I invested in this other deal and they're doing an IPO. But we're talking about very late stage deals. I'm not talking about you saw an early stage startup opportunity where they said, oh, our exit is an IPO 6 years from now, because the risk of them getting there in a reasonable time, 5 to 7 years, is frankly very low because they got to go through a lot of things to get to that point, right? What you're looking for is companies that are already at that point who are just waiting for the market timing, or maybe they want to do one more private round before they go public to get a higher valuation or whatever it is. You want to be investing at the very tail end to, again, shrink that time horizon of how long it takes. So we're avoiding early stage, high risk deals. We're looking for late privately held companies, very late in their life cycle, very high valuation. Maybe they've already filed or announced an IPO. So we're kind of riding on those coattails. And then when they go public, we're looking to sell. We're not looking to hold, and I'll talk a little bit about that more in a minute. We're looking to exit when they do their IPO. Again, I'm just trading the spread, should I do it that way, between the valuation of the company when it's privately held versus the valuation of the same business when it's publicly traded. I'm looking to capture that spread. So we're looking for companies with established revenue trajectories, market fit, established, stable, very well thought of businesses. We're looking for a clear path to liquidity. I'm hoping to get 3 to 5 years, but I'm not looking for 3 to 5 years. I'm looking for 1 year, right? And then I figure, hey, they're delayed. I come liquid in 2 years. Okay, I'll take it, right? So you're looking for companies that are either announced an IPO or on the verge of an IPO, or for some reason you think they're going to have one very soon. Valuation is critical here. You can buy lots of pre-IPO stock at a way too high valuation because you have these crazy people who have some shares they want to sell. They just list them on a site for a very high price, and if you don't know better, you'll pay too much for the stock. So you want to make sure that you pay a lot of attention to valuation. Now, how do you do that? How do you know what valuation you should buy Kraken stock at, for instance? Well, it's a little bit different than a traditional business or a traditional business valuation, right? So first of all, I want to know, what did the private equity guys that just most recently invested in the company, what valuation did they pay? And I want to be under that or at or around that price, preferably under that valuation, okay? Because the investors, who hopefully are way smarter than me, more sophisticated than me, and it matters who they are, I look at that also. They think that the company is going to go public north of what they're paying. So if I can pay that or less, man, I'm gold, right? So I'm looking for somebody maybe who's a motivated seller, who's willing to sell at a lower valuation because he needs liquidity, he needs the money quickly, right? I'm an opportunistic buyer, just like you would be looking at a depressed multifamily property where you can pay less and turn it into something more valuable. I'm looking for that sort of situation. Strong governance. I want trustworthy management team. I don't want, hey, the management team just got fired, any of that sort of stuff. I'm looking for stable ships, right? Another thing, we talk about this for every asset class, but it is even more important in pre-IPO deals. You must do two things. You must look at lots of different pre-IPO companies in different sectors. You have to understand, what does the market look like? And then let's say you pick Kraken. I want to invest in Kraken. Well, you need to look at lots of opportunities to buy Kraken, because how do you know if it's a good deal if you don't know all the deals that are out there? And remember, if there's, sometimes I've seen this happen where there's none of it available, and all of a sudden you see somebody puts it on sale for $27 a share. Well, if you don't watch over time, you won't see the 20 other offerings, the 10 that happened in the last couple months and the 10 that will happen in the next couple months, that show that 20 is a better price, right? But if you just look at a snapshot on a single day, you don't have a sense of what are good prices for that stock. In the case of Kraken, there's another factor, which is typically these companies, because I'm buying shares from another shareholder, not from the company has to approve the transaction. Really, it's not a yes or no, it's a right of first refusal. If the seller says, hey, Tom, I'll sell you my shares for $20 a share, I can tell you right now, Kraken is going to exercise their right of first refusal and buy the shares out from underneath me. So even if I could find a buyer for $20, I wouldn't be able to get the shares for that because the company would buy them. It's about 23 now that is kind of the lowest price you can buy them for, that the company won't take them out from underneath you. And so if you didn't know that, then you're out there in this wilderness of all these, well, not wilderness, wild, wild west. It's even worse than the wilderness probably, of guys offering different shares for different prices, and you have no idea what's good, what's not, etc. You should have some industry expertise. You should understand something about the business. In this case, a online cryptocurrency trading platform, the industry, how this company plays in the industry, that sort of stuff. Now, it's not the same level if you're investing in an early stage privately held company where you really got to know everything about the business. You just kind of want to get a general sense, make sure you understand the ups and downs of the business and what might happen in the industry that could affect not necessarily the business itself, but rather whether or not it can go public at a good valuation, right? Negotiate. This is why ticker tape exists, right? Because Tom Schmidt, attorney in Houston, Texas, has no political clout and frankly, not enough financial capital or clout to be able to negotiate better terms for my investments. However, ticker tape investments, which is investing 20 times the amount that Tom Schmidt is personally, sometimes 10 times, sometimes 50 times, but you get the point, has a lot more ability to negotiate. So if you don't invest with us, which is fine, it's not a hard sell, but if you don't invest with us, find a way to piggyback on some other group that does have the ability to negotiate, because all these deals are one-on-one. It's almost like a flea market, right? That guy lists his stock at 27. There's nothing magical about that. You ought to be able to get him to come down to 25.50. Now, if people are snapping it up left and right, you need to know that. You need to be watching the marketplace and understand it. But then you'll know when to jump on one because it's way too low. Because that'll happen too, right? You'll have a lot of people list their shares or advertise their shares for too high a price, hoping to find someone uneducated to buy it. But some people will make an uneducated mistake. They don't know that there were just 5 sales at 30, and next thing you know, they offer theirs at 25, and you should pounce on it, right? So you need to know that stuff. How do you do that? You look at lots of deals, you watch the market constantly, and or you get someone else to do that for you. In other words, you join a group like Ticker Tape, or maybe you get 5 of your own friends and do it together, but have people doing this full-time, watching the market, understanding what's out there and what's not. And then obviously I want to look at the track records of the investors that are in the company, the management team of the company, some of the same old due diligence stuff you would do for any investment. So again, you want to join groups that know what they're doing, that invest in these types of deals, and let them carry a lot of that lifting. And then that way you can just ask them the question, hey, what's out there? Hey, how many deals have you looked at? What have we seen? What have we not seen? What do we know about this space? And as opposed to you having to go figure the answers to those questions out. Look for value. This is critically important. And we've even made mistakes a couple times. Typically, I don't think we've ever made this mistake on a single transaction, but sometimes we've done a block of a particular company. Then we got the investors came and said, hey, we want in and we're sold out. So we did a second one or we did a third one. And a couple of those third ones are at higher prices, frankly, than I wish we had paid, because by then there was sort of more excitement about the company. And so watch out for that, but make sure you're paying attention to what you pay for the shares. Again, you've got to look at hundreds and hundreds of deals, hundreds of different companies. And for the company you're interested in, multiple different deals that have happened for that company, so you know what's good, what's not. And then, of course, the other cheat code, right, is diversify. You don't have to win every deal. Just place a series of bets, have the capital constantly rolling over multiple ways. And if some of them don't generate a high return, or even if you take a loss, we haven't had to take a loss on one yet, but even if you take a loss, you've got other ones going on that are going to make up for that. And it's not like a venture capital fund where you got to make 20 bets and only one of them is going to hit, but you should have a much higher success rate, and even the losses should be less impactful, because it's not a situation where the company goes out of business, you lose all your money. Like in a startup, typically you may just only get 90% of your money back or break even or something like that. So, but again, diversification is gonna make a big difference for you. Okay, a couple of case studies, and there are great lessons in these. The punchline for our SoFi deal is it's better to be lucky than good. I actually was looking at something else today, and I noticed that we closed our deal on January 13th, and it was a matter of like 3 or 4 days later that the company announced they were doing a SPAC merger. Now, it wasn't entirely luck, right? We had vetted the company. We knew they were looking for a SPAC deal. We knew they had had some conversations, that they wanted to go public, all those sorts of things. But in terms of timing, we couldn't have planned it better. We literally closed the deal a few days before they were public. And within 7 months, I had sold my shares and I was totally out with a 4+ times return on my money within a year, less than a year, right? Huge win, great success. That's kind of the poster child of what we're trying to achieve here. Palantir is a little bit different. So the first thing was we made a mistake. It was one of our first deals, might have been our second or third deal. We did not buy the shares, or how do I say this? We did not negotiate our deal, that is, negotiate the price, until after Palantir had announced it was going public. As a result, we paid too much for the stock. That's a relative term. We paid too much. We should have bought it a year earlier or 6 months earlier, where we would have been gambling and therefore have that gambling premium into the deal. Nevertheless, I was able to sell my shares for a little better than double my money in about 8 months. Maybe it's not, I think, sorry, this was 9 months. 9 months. Not a bad result. One of the things that happened, though, is that we told all of our partners, sell your shares. And remember, when you do a pre-IPO deal with Ticker Tape, you decide when to sell. We just give you your shares, and then you can hold them forever or sell whatever. So we told everybody to sell, and sure enough, the stock price tanked. And I got all these phone calls. Tom, oh my God, what do I do now? I should have listened to you. You sold. You told us to sell. We didn't, whatever. And so my advice, which turns out to have been bad advice, was, look, we had a specific purpose. Buy private, sell public. You kind of missed that now. So I would take my loss, sell my shares, and move on to the next deal. Several of those investors did not follow that advice, and they held the shares. And look who got the last laugh. They're at $125 a share now. I think I sold in the 30 range, 32 I think was my average. So I could have held it all these many years later, 4 years I think, and made another, what is that? 4 times my money, 4 times my profit that I took, right? Not 4 times my investment. Would have been 8 times or something. So again, that wasn't the strategy, right? What you're supposed to do is you do your pre-IPO deal and you exit. Take your profit or your loss, whatever you got when they go public. Then if you want to reevaluate the company a couple quarters later after they report earnings, you get more information about the business. So now you can really evaluate the business. Because remember, we're buying all these companies. They have not filed financials. We do not have detailed financial information on the vast majority of these companies because they're privately held. And so, again, I don't want to take that risk. I'm not able to evaluate the long-term perspective. I'm just going to sell when it goes public. WeWork and Airbnb are 2 examples where we looked at those 2 companies aggressively. We really wanted to participate in both, and in both cases we passed. WeWork, to be honest with you, I had had some bad experiences with Regus, the office sharing business that was similar to WeWork. And when I looked at the WeWork deal, I saw things that didn't make sense to me because I'd had prior experiences, and that combined with it sort of got out from underneath us. It became so popular and the price was bid up so much. I said, look, I don't see any value here. I'm worried about this one. One of our partners, one of our investors, I think he lost $500,000 on WeWork because he invested by himself early on. Now, it was not like he went against us. We were not talking at the time about that topic, so he wasn't aware of the work we were doing. But he took a big beating when that company failed, as did a lot of people. I don't know that, I don't see any correlation between the reasons we didn't buy and the fact that it failed. So I think, again, it was sort of more luck than anything that we avoided it. But what I can tell you is I deliberately didn't pay that price. It felt too frothy to me. Same thing with Airbnb. Love the company. They've revolutionized the industry. Long term, I love the business. I just feel like the company has always been overvalued since the first day I looked at it as an investment. And so we passed on that one as well. Maybe because in part, not so much in the case of WeWork, but in the case of Airbnb, we were a little bit late to the party. It took, for whatever reason, I don't remember what we were doing, but by the time we started looking at it, again, the price was very high. So what do you do? How do you get into this stuff? There's lots of information online about opportunities to buy these companies. If you want to do it yourself, you can Google them. There are multiple companies that have like a marketplace that you can register and get into, and then you can see opportunities to invest anywhere from 25,000 to $1 million or more. And you can see opportunities to buy these shares. Buyer beware. Some of these companies have gone belly up and investors have lost money. Some of the deals, well, let's just say it this way, the deals are designed not by these companies, but by the sellers to take advantage of you, right? That you'll get caught paying too much for a stock. And so I just encourage you to be very careful. In the alternative, we're happy to schedule a consultation with you for free, tell you a little bit about our process and what we do. You can get on our list and get access to the opportunities that we've already vetted and have decided to invest in, and kind of, again, piggyback off of our work if you can't find a group that you trust to follow along. And then, of course, we put together a due diligence packet, the vast majority of which is publicly available. So literally, it's not like we get access, typically, we don't get access to inside due diligence reports. We're having to go pull the information from public sources, which we'll share with you guys. Right now we have, I think it is 4 open pre-IPO deals. Utility Rescue, Kraken, we're buying a second round of Kraken. SpaceX, we're doing SpaceX 5. And then Anthropic is technically our first purchase of Anthropic. We actually got pretty far down the road once before, and then ultimately we're not able to close the transaction on the terms we wanted, so we passed on it. So this is kind of a redo of trying to buy Anthropic for the first time. And so if you're interested in one or more of those, or just kind of want to hear about the process, reach out to Rita. She can set up a consultation for you, answer any questions you may have. The best way to get her is to text her at 832-459-7335. You can also email her or reach out on social media. With that, I'll let you guys go. We'll see you next week on Thursday at the same time. And next week, I think we're going to be talking more about this rolling investment strategy and the impact of that on your investments. But stay tuned. We'll obviously announce the details of that presentation early next week. Look forward to seeing all you guys again. Make sure to check out ttifund.com. There's tons of content on there to help answer any questions you have and help you advance your investing journey. Look forward to talking to everybody next time.